the Baoshang Bank takeover by the PBOC, the People's Bank of China, China Central Bank, and Chinese financial regulators and Chinese banking regulators. Was it the beginning of a liquidity crisis in China? So we are now about a month removed from the Baoshang Bank takeover. It occurred on May 24th, officially with the press release. And lately, in the last 10 days, a lot of additional information and news stories has come out. So much news and information that has come out that I don't have time to read it all for you guys. I'll just attach links to all these stories that I found. And I found stories from pretty much everywhere that you can think of. The Financial Times, the Wall Street Journal, the New York Times, the Economist. There's a lot of in-depth coverage. Bloomberg, there's a lot of in-depth coverage on this. And basically, it seems to me that the Baoshang Bank takeover, it was a very small bank, but then within about a week to 10 days, then there was another larger bank, and that bank refused to give over loan documents to auditors. Then there was an emergency liquidity program, another program announcement by the PBOC for $70 billion. And you know, it's just, the news stories just keep on coming about the Shanghai Interbank Operating Rate, or SHIBOR, which is China's version of LIBOR. And these stories, they don't seem positive. Okay, I'm sure they're being spun to be positive, but it seems like there's definitely a liquidity crisis, and the banks in China trust, counterparty risk, collateral problems, liquidity problems, over leverage. These problems all seem to be coming into play. So problems with collateral, problems with counterparty risk, problems with liquidity. And this should not surprise anyone, because in 2018, and I told you I'm good at research, I went back and looked for this. In March of 2018, the Bank of International Settlements put out a report warning about over leverage and liquidity problems in the future for Chinese banks. So also for Hong Kong banks that were lending too much to China with bad collateral and dangerous credit risk, and also Canadian banks. So these problems have been mounting for a while, and it looks like China is the People's Bank of China, the people running the Chinese government, the Chinese banking sector, Chinese financial industry, are attempting to stop this, but it is not really going too well. So let me give you guys 2 minutes of the McIlvaney weekly commentary from this week. I think it's important. I listened to it Wednesday afternoon, and I'll play 2 minutes of it for right now. Hopefully you'll be able to hear this. I tested this out on the pre-recording. You should be able to hear this right now, talking about how much liquidity China is injecting just in the last week.
Let's face it.
You say China, you mentioned China.
Yeah.
The PBOC, their central bank, is making sure that there's ample liquidity flowing right now. Last week, there was over $40 billion injected into the banking system to bring calm to what otherwise could have been significant sort of bank run dynamics. But the markets themselves in China are discriminating between the large banks and the non-bank financial institutions. You have the overnight repo rate, which dropped to as low as 1% for the big banks. And that is as a result of the central bank intervention. But your non-bank financials, they remain at a much higher 8% for overnight borrowing. And so what you're seeing is that liquidity is not flowing equally. And as Doug Noland pointed out in one of our recent portfolio manager meetings, that is precisely a late in the cycle dynamic.
And the Chinese must be expecting a too big to fail kind of move where you only have to pay them 1% for that repo rate for the large stuff. But the non-bank financials, you said 8%. 8% is a high rate in this environment.
Right, so the difference is between the repo market and the pledge repo market. And the pledge repo market is sending a strong signal. And that signal, and this is again in contrast to the repo market, not everyone is getting the easy money from the PBOC. PBOC is creating it. And as we've said many times before, you've got central banks that create liquidity, but the markets direct the flow. So you create the liquidity, markets direct the flow, and this is how the unseen hand of the market works, whether it's self-interest, self-preservation. That unseen hand determines who gets what.
Isn't it strange? Okay, we've got a country that still is communist, that's looking more like a free market country, where we're actually seeing dynamics. An 8% interest rate shows free market dynamics. Yet here in our economy, which is supposed to be free, we're almost more command and control.
And of course, Xi Jinping has tightened controls. We know that he's eliminated, he's given himself kind of a lifetime rule. Since Mao, there's no one in China who's had more concentrated power than him.
He controls the vertical, he controls the horizontal, he actually controls the central bank.
Yeah, well, so there's irony, you're right, that you have some, not all, but some free market dynamics on display in China. And then you cross.
Okay, I think that's enough. I just wanted to talk about that segment there about how creditors now, interbank lending in China is becoming very untrustworthy. The banks now in China, even though the People's Bank of China and other banking regulators and other people inside China in the banking and financial system, the higher-ups in charge of this, are trying to flood the Chinese banking system and Chinese financial system with liquidity, it's not really working. Because let me read an example of this from the Financial Times article. It says, many of China's more than 4,000 banks face difficulty raising deposits in smaller cities and rural areas. Okay, let me see. I might have pulled up the wrong article. I have so many articles open. 1 second. Okay, nearly 3 weeks after, I'm reading the New York Times article from June 21st. Nearly 3 weeks after Chinese regulators took over troubled Baoshang Bank, a mid-sized mutual fund house in Beijing suddenly became unable to borrow cash in the interbank market and was forced to default on some products. Around the same time, Great Wall West China Bank, a regional lender in Sichuan province, set out to sell negotiable certificates of deposits, or NCDs, usually a routine fundraising tool for small lenders, but was only able to raise a tenth of its targeted amount. Both examples highlight increasing distrust in China's interbank market as smaller banks, asset managers, and brokerages find their creditworthiness questioned in the wake of the takeover of Inner Mongolia-based Baoshang. So I remember when I was talking about Baoshang Bank that people were saying it's no big deal, they're tiny, it doesn't matter, and now look at this. It's setting off a chain of events where people are starting to question other small banks. They don't want to lend to them. Okay, back to the article. Fund managers and traders say they are worried about prospect of further defaults in interbank borrowing, as well as more troubled banks coming to light. Quote, as the old saying goes, when you see one cockroach, you will discover a swarm of them. End quote, says Liu Haiying, a founder of Shanghai-based Haiying Investment and author of the book China's Huge Debts. Worryingly, Baoshang Bank is likely that first cockroach. That was his quote. Particularly shocking for the market has been the government's decision to only guarantee the principal for interbank deposits with Baoshang worth 50 million yuan or less, shattering a widely held belief in full government guarantees for assets. And also there's been other press releases and announcements that I think creditors of Baoshang Bank and other future bank bailouts are risking a 30% haircut. So they're only going to get 70 cents on the dollar. Short-term interbank, this is from June 21st, so it's 6 days old. Short-term interbank lending rates have spiked to as high as 15% this month from more normal levels of around 3.5%. Quote, the liquidity stress we're witnessing now is rooted in concerns over insolvency, which is very difficult to cope with, end quote, said Liu, adding that while authorities were right to try to clean up problems, they risk creating chaos in the financial system. Many small lenders rely on short-term borrowings for long-term investments, and surging financing costs could hit their returns or force them to liquidate assets. That in turn could further strain liquidity conditions in a market that is also a key fundraising channel for smaller fund houses and brokerages. And then there's more funding woes. The Beijing-based fund house New China Fund Management told clients on June 12th it needed to sell assets after defaulting on several products, according to a letter it sent that was reviewed by Reuters. Asked about the letter's contents, the fund house said in an email statement it was, quote, obliged to take active measures to flag and reduce risks, end quote. That sounds like bullshit. Okay, back to the article. It has not publicly disclosed the size of the default or whether it has made repayments. Okay, so controlled by Hengtai Securities Company Limited, New China Fund ranked 62nd in terms of assets among 124 Chinese mutual fund houses as of March 31st, according to fund consultancy Zben Advisors. Great Wall West China Bank, which has an investment-grade credit rating of AA, has sought to raise 500 million yuan. According to an interbank market statement, it offered a 3.9% yield on one-year deposits, above the 3.25% offered by issuers of NCDs with top-notch AAA plus credit ratings. So I can read more of this, but let me just skip to another article. So these NCDs seem to be where there's big problems, and the NCDs may be bad collateral. So not only do you have the banks not trusting each other, but you have bad collateral in a over-leveraged banking system that was warned about by the Bank of International Settlements over a year ago, and it has taken on even more credit and even more leverage. So eventually, at some point, it was going to hit a tipping point. So let's see here. After the takeover of Baoshang Bank, the demand, this is the Financial Times article, the demand for regional banks, interbank NCDs declined, and the pricing tightened to reflect heightened uncertainties as to whether and to what extent the government would apply similar resolution strategies to other distressed banks. Moody's analyst Yulia Wan wrote in a report this week. So the banks in China, the Chinese government, and this is evidenced by SHIBOR, Shanghai Interbank Operating Rate. They knocked it down, I think, to the lowest levels since 2008 and 2009. And I have a couple different articles about it. There's 3 different articles about it for how the People's Bank of China and the other banking regulators lowered SHIBOR to try to flood the system with liquidity. And you heard on the McIlvaney, the 2 minutes I played of this week's McIlvaney Weekly Commentary, that they're flooding additional liquidity besides the SHIBOR manipulation down. But it's not enough. The banks are not trusting each other. There's counterparty risk. This should remind you of the U.S. in the U.S.'s banking and housing crisis in 2006 and 7. So before Bear Stearns, before Lehman Brothers, there was Indie Bank. And Michael Pinto, who's a guy I respect a lot, he wrote an article on June 17th, so about 10 days ago, because it's June 27th now when we're recording this. I'm doing this late at night. And he wrote that Baoshang Bank could be China's Indie Bank. So basically that even though Baoshang Bank isn't very big, that because it was not bailed out, because in the past China did not announce bailouts, and that many Chinese people expected 100% bailouts, and now the Chinese government is going to be giving people haircuts. It looks like 30% haircuts. That now it's going to create a big panic among banks lending to each other, looking at collateral more, looking at leverage ratios, those kind of things that they should have been more prudent with that they were not. And if you want to read Michael Pinto's article, I'll attach it in the information section. I'm not going to read the whole article for you guys. There's too many articles to read on this. Literally, I found related to this more than a dozen articles just in the last 10 or 15 days. So there's a lot of information coming out now about the liquidity crisis, the banking crisis. And let me try to find the article where it said that even though China is flooding the banking system and financial system with liquidity, that liquidity is not going to the small banks. So that liquidity is only benefiting the big banks. The small banks are still getting screwed over. The small banks are not getting any of that liquidity. And the Chinese want the small banks because they know if enough of them fail together, it could create a chain reaction, but they're not getting the liquidity. So the liquidity is going and being hoarded by the large banks. And if you read China's Great Wall of Debt, which I think is a great book, I highly recommend it. He talks about also, besides these NCDs, which I mentioned earlier, these wealth management products, or WMPs, and these things are also big red flags. So there might be some legit mutual funds or other things in there, but these wealth management products, or WMPs, have been used as collateral to leverage up and all kinds of crazy financial tricks in the Chinese banking and financial system. So I have a bunch of articles on this. One of the interesting theories, though, and this is by a financial industry blogger. I think he worked in the financial industry for many years. He does not use his real name. He has a website called Deep Throat IPO. And his whole theory, and he wrote this long explanation of his theory on May 7th, 2019. I'll attach a link to it if you want to check out his theory, is that China is protecting their currency, and they're intentionally like hyperinflating their currency and waiting to dump U.S. assets, and then the other major central banks will step in with QE, and then China will try to internationalize their currency then. So I'm not sure I agree with that, but it's an interesting theory that he has. If China's actually trying to do that, there's things that the U.S. could do to counteract that. The U.S. has seized foreigners' assets in the U.S. before, so there's ways for the U.S. to get around this. So even though a lot of Chinese own real estate and other assets here in the U.S., in the event of potentially like another currency crisis, or China tries some crazy trick to flood the global economy with lots of RMB to buy up even more assets or something, or destroy the dollar, the U.S. could potentially just start seizing assets in the U.S. that are owned by Chinese. The U.S. has done it before. It did it with Japanese Americans, right, during World War II. So there's so many articles here that I cannot talk about all of them, but the bottom line is that even though the People's Bank of China and other Chinese banking and financial officials are flooding the Chinese banking and financial system, so non-banks, so money managers, mutual fund companies, flooding them with liquidity too. Apparently, from what it looks like from the articles I've read, it looks like some of these Chinese mutual fund companies were way over leveraging their assets too. So they were acting like hedge funds or banks and doing real estate speculation, and they were doing derivatives trading too. So it looks like one giant mess to me. And I've read a handful of these there's so many articles. I've skimmed through a lot of them. But it just seems like there's one giant mess. Let me check my notes here and see if I covered. Okay, so the wealth management products I talked about. So some of those things are toxic and there's bad collateral in there. And some of them are totally worthless. Some of these wealth management products. That once a Chinese company, private Chinese company that could not borrow from the large banks, they made a profit. And then they went and deposited the money at a large Chinese bank, even though they could not originally borrow from the large Chinese bank. And then they got wealth management products after they made a deposit at the large Chinese bank. And then the wealth management products were used as collateral for other bets and other crazy derivatives and leverage stuff, often in real estate or other types of credit speculation. So a lot of these wealth management products could be toxic, like mortgage-backed securities. They could be really, really bad. They could be subprime or worse. And then there's a bunch of peer-to-peer lending scams in China, like big websites that have peer-to-peer lending online. And then it ends up being a Ponzi scheme where the person who started the website, the company who started the website for peer-to-peer lending, sometimes tries to take the money and run. There's just massive amounts of corruption, over-leverage, and fraud in the Chinese banking and financial system, from what it sounds like. Just reading a bunch of these articles in the last couple weeks. Okay, let me go through a couple more of the articles that I pulled up. Okay, so this is the Economist one. Let me see here, skim through it to get to the point I wanted to. Okay, here we go. So, at just 30% of GDP, less than half the average in advanced economies, government debt in China might seem under control, but that misses much of what is happening. Local governments have long relied on off-balance sheet debt to solve a perennial policy quandary. They are responsible for about 85% of public expenditures, yet command only 50% of revenues. Moreover, central authorities make it hard for them to borrow formally, hoping to limit their profligacy. So they have created entities such as Xiantan Xinhua, referred to as Local Government Financing Vehicles, or LGFVs. These are registered as companies, but creditors know, or rather assume, that the state stands behind them. In other words, that the only reason that they can borrow is they expect the Chinese government to bail them out. At last count, and this article is from June 24th, so only a couple days ago. At last count, China had 11,566 LGFVs, or local government financing vehicles. So these are like dummy corporations that these municipalities set up to do all kinds of investing and borrowing and, you know, whatever, wasting of money, maybe hedge fund trades, storing copper in a warehouse, God knows what. So according to the IMF, when they were factored in, government debt rises to about 70% of GDP. I think it's more than that. I think China's debt, well, China's total debt to GDP is closer to 300% now. Okay, so I read that part. If you want to read that article, and let me see, the Financial Times one, did I read the stuff in there? The negotiable certificate of deposits, I talked about that. Okay, here we go. That's a quote. I was in the right article, but I missed the quote. Quote, the large banks have been very reluctant to lend to small banks, so the People's Bank of China has had to lend directly to them, end quote. This is from the Financial Times article. Pressure on funding for small banks comes at a difficult moment for China's banking system. While most analysts believe the country's large banks are well capitalized, some mid-tier banks and many smaller institutions face rapidly rising bad debt as China's economy slows down. It's not just a concern on credit risk, it's also the resolution mechanism for defaults on interbank borrowings, said another analyst. So things are getting a lot worse in China. And that's why Bitcoin is going up. That's another reason why gold is probably doing well. Silver is not done well. You would expect silver to do well. And yet here we are. So I was surprised when that Baoshang Bank announcement occurred about a month ago. And then we had a couple weeks after that, we had the head of the People's Bank of China go on Bloomberg Asia and do an interview. And that was damage control. The RMB has not gotten past 7 to the dollar, so they did stop that. They didn't want the RMB going past to 7 or past or more devalued. So they have stopped that, but they have not stopped the interbank problems, the liquidity problems in the banking system. And the gold to silver ratio is what? It's over 90 now. It's just getting more and more absurd. Meanwhile, the silver miners are on the ropes here. We're at a gold price now where some of these mid-tier gold miners are going to start raising money. I don't know how much they can raise, but they'll raise some. Hui Tran says China will be many small countries. I don't know about that. I don't think the Communist Party of China, it's late at night, it's almost 1 a.m. Communist Party of China will allow that. I don't think they will allow a decentralized provincial governments without a large overhanging, large federal government and bureaucracy. I'm not sure that would be allowed. Oh, we got someone watching this from Beijing. You have to have a VPN there. Who dumped Fannie Mae, Freddie Mac 2008, causing the crisis in the U.S.? The U.S.'s crisis was worse than just Fannie Mae and Freddie Mac. The banks stopped trusting each other. It was when Lehman Brothers failed. More than just Fannie and Freddie. And from what I've heard from experts, a lot of the mortgages that Fannie and Freddie had actually never defaulted. So they did start buying bad mortgages, but the majority of mortgages they had never defaulted. So Fannie and Freddie's shares, their equity obviously collapsed. But the underlying, a lot of their mortgages that they were buying, a lot of them did not default. So I didn't want to spend too much time on this. It is late at night, and there are tons and tons of articles. I don't have time to read all of them. So I just wanted to do this short video update on this. And based on the new news stories that are coming out in the last couple days are on the SHIBOR, Shanghai Interbank Operating Rate, okay, which is the Chinese version of LIBOR. And by the way, LIBOR just went inverted, which is another red flag, but that's not to do with this video in China. But the details that are coming out about SHIBOR are pretty damn bad. The banks are stopping trusting each other, especially small and medium-sized banks. The large banks don't trust them. And it seems that the Chinese government intended for the liquidity to go to the small and medium-sized banks, and that's not happening. On top of that, the non-banking financial institutions, so the wealth management companies in China, like the mutual funds, it looks like they were over-leveraging too. That, normally think of it like Fidelity or one of those companies, or Vanguard here in the US, or BlackRock. You don't want Fidelity or Vanguard or BlackRock acting like a hedge fund, acting like long-term capital management, acting like Lehman Brothers, acting like Bear Stearns. And from what it looks like, a lot of non-banking financial institutions in China or wealth management companies have been messing around, playing games with their balance sheet and borrowing money they should not have borrowed, taking their customers' assets and leveraging those things way more than they should have. Maybe a little bit of leverage would have been okay. A little bit. But the amount of leverage it sounds like that there's in the Chinese banking and financial system is unbelievable. And all it takes is a couple, when you're that leveraged, and people are like, Baoshang Bank is too small. But when you're that leveraged, and it does not take a lot. So let me just give you an example. They say that, I think, Lehman Brothers, were they leveraged 60 to 1? Bear Stearns was 60 to 1 and Lehman Brothers was 40 to 1. So if you're a bank or an investment bank and you are leveraged 40 to 1, it only takes a 2.5% drop in the value of your assets for you to be insolvent with those leverage ratios. And for a 60 to 1 leverage ratio, like Bear Stearns was, it only takes like a 1.5% approximately drop. So all it took, and their model said real estate will never fall. Real estate prices will never fall. So it seems that a lot of the same mistakes that the U.S. banks and housing crisis that caused the housing crisis in 2008, a lot of those same mistakes have been done in China, already been done for a while now, and they're multiplied. They're even larger. Douglas says the USA will be the last to go. The whole system is being used to subsidize the US. You may be right about that. Looks like the European Union, if on probability, looks like the European Union is in a lot of trouble. Emerging markets are in a lot of trouble, and China is in a lot of trouble. In that order. So European Union, emerging markets, China, and then maybe the US will be safe for last. People seem to be ignoring Japan, but Japan can't afford any type of rate increases. Japan just keeps doing, this Japanification, and everyone else has copied them. But Japan's been doing this longer than anyone else, and Japan's central bank is definitely trapped. Okay, guys, well, that's it for today. It's late at night. I could talk a lot more about this stuff, but if you want to check out the details and go into the weeds, I will put a lot of these articles in the information section of the video. But the bottom line is I discussed the timeline of how the People's Bank of China, how they went into damage control. And the damage control, the culmination of that, started with the interview that the head of the People's Bank of China did on Western television on Bloomberg Asia. So that's very rare. It's very rare because for 30 years, whenever there was bank failures in China, they were never announced. Westerners never really found out about them. I'm not even sure how many Chinese even found out about them, if it was even put in state-sponsored media in China. But Westerners, if there was bank failures prior to the Baoshang Bank failure, Westerners never found out. And now here we go, a month later, after the Baoshang Bank failure, which was on May 24th, and things are just escalating. Every day or every couple days, there's another news story with more details about liquidity problems in the Chinese banking system, about counterparty risk, lack of trust, banks that are not lending to each other, problems with the non-banking financial institutions. So this is going to get, based on the articles I'm seeing and the details that are coming out over the next 6 to 12 months, this is going to get a lot worse before it gets better, because the People's Bank of China and the Chinese banking and financial regulators have tried to flood the system with liquidity, but the liquidity is not going to the small banks. It's only going to the large banks who are hoarding the cash, it looks like, and only lending with each other. And for banks to operate, they have to lend to each other. They have to trust each other. It's a trust. There's some trust involved. Jack says no problem if you own the printing press. So the RMB debt can be bailed out. But China, a lot of these Chinese banks, Chinese corporations also have dollar denominated debt, and that is part of the problem. Okay, guys, well, that's it for today, and I have a lot of article links. I have like a dozen windows open of articles right now, and there's more. I have a dozen article links to put in the information section of the video, and everyone have a great rest of your week. I will try to get another interview or two done, hopefully in the next couple days, but we'll see. Okay, bye for now.